You were taught the Pythagorean theorem. You were taught the water cycle. But nobody sat you down and explained how money actually works until it's already costing you. By the end of this video, you'll understand the handful of concepts that quietly control your financial life: compound interest, inflation, assets versus liabilities, credit, and risk. No fluff. Let's go. Section 1. Compound interest. Let's start with the concept Einstein allegedly called the most powerful force in the universe: compound interest. True story or not, it's not wrong. Here's the idea in one sentence. You earn interest not just on your original money, but on the interest that money already made. Say you invest $1,000 at a 7% annual return. After year 1, you don't just have your original $1,000, you have $1,070. Year 2, you earn 7% on $1,070, not $1,000. Small difference at first, but stretch that out. After 30 years, that single $1,000 becomes over $7,600 without you adding another dollar. That's the snowball effect. Now, here's the part people forget. Compound interest also works against you. Credit card debt compounds the same way. If you're carrying a balance at 22% APR, that debt is snowballing just as fast as your investments could have been. Takeaway: time in the market matters more than timing the market. The earlier you start, even with small amounts, the harder compounding works for you. Section 2. Inflation. This is the reason your grandparents talk about a nickel candy bar like it's mythology. Inflation is the gradual rise in prices over time, which means the same dollar buys less tomorrow than it does today. At just 3% average inflation, prices roughly double every 24 years. So $100 sitting in a piggy bank, not invested, not earning anything, will only have the purchasing power of about $50 in 24 years. This is why saving and investing aren't the same thing. Cash sitting still is quietly losing value. It's not that your money disappears, it's that everything around it gets more expensive faster than it grows. Takeaway: if your money isn't earning more than the inflation rate, you're technically losing wealth, even if the number in your account looks the same or bigger. Section 3. Assets versus liabilities.
Here's a distinction that changes how you see every purchase you make: the difference between an asset and a liability. An asset is something that puts money in your pocket over time. Think dividend-paying stocks, a rental property, a business. A liability is something that takes money out of your pocket over time. Think a car loan, a boat, most consumer debt. A lot of things marketed as investments are actually liabilities in disguise. A brand new car, for example, loses roughly 20% of its value the moment you drive it off the lot, and then keeps costing you in insurance, maintenance, and loan interest. Takeaway: before a big purchase, ask one question: does this pay me or does this cost me? Neither answer is automatically wrong, but you should know which one you're choosing. Section 4. How credit actually works. Now, let's talk about the number that quietly follows you everywhere: your credit score. Your credit score is essentially a trust rating for lenders, built from a few key ingredients: payment history, about 35%, do you pay on time; credit utilization, about 30%, how much of your available credit are you using; length of credit history, about 15%, and credit mix and new credit make up the rest. The single biggest lever you can pull is utilization. If you have a $10,000 credit limit and you're carrying a $6,000 balance, that's 60% utilization, and that alone can drag your score down, even if you pay on time every month. Rule of thumb: keep utilization under 30%, ideally under 10%. Takeaway: a good credit score isn't about how much you borrow, it's about how responsible you use what's available to you. It's the difference between a bank seeing you as reliable versus risky.
Section 5. Risk and diversification. Last concept, and it's the one that determines whether a bad month wipes you out or barely registers: risk, and how you manage it through diversification. Every investment carries risk, the chance that it loses value.
The mistake most beginners make isn't taking risk, it's taking concentrated risk, putting everything into one stock, one company, one idea. Diversification means spreading your money across different types of assets so that no single failure sinks the whole ship. If one sector drops 30%, but it's only 10% of your portfolio, you feel a bruise, not a break. A higher potential return usually means higher risk. There's no free lunch. Takeaway? You can't eliminate risk, but you can control how much any single bad outcome is allowed to hurt you. Let's bring it all together. Compound interest rewards patience. Inflation punishes standing still. The asset/liability lens changes how you spend. Your credit score rewards discipline, not wealth. And diversification protects you from your own mistakes.
None of this requires a finance degree. It just requires knowing the rules before you play the game. Which concept do you wish you'd learned earlier? Comment below. If this helped, subscribe for more breakdowns like this, and I'll see you in the next one.